So welcome all to the NDB quarterly investor update, which I have been doing for the last several years. And this is to update the performance up to first quarter 2022. And with me, we have several of our leadership team who would later on in the Q&A session would take part, whilst I will take you through a prepared presentation. All the screens. So I'll straight away get into the financial, but before that, just to highlight 41 years in operations, and we have been providing commercial banking services over 113 branches. The one key update that I want to provide is during the quarter, NDB was recognized as the best commercial bank by Global Finance of USA. This is the fourth time that we recognized during the last 5 years. So that's something that I thought I'd better mention. Moving on to the operating environment, especially the first quarter 2022 was one of the most difficult quarters that we all have experienced, and things are still continuing. But during the quarter, what we saw was the monetary policy getting tightened. During the first quarter, it was about 150 basis point increase in SDFR and SLFR, and also in the bank rate. And subsequently, in April, this was further tightened by a very substantial 50 basis point increase in policy rates. Also, we saw our foreign reserves depleting rapidly, and also the reality that we see now, we saw that coming actually much earlier, but the first quarter we saw it's further deteriorating. One good thing that happened was the peg that was kept for a long time, rupee being pegged to the dollar around 200, was removed by the central bank. However, that decision was made without having, I must say, proper breaks. So as a result, we saw rupee depreciating rapidly. But now that has been arrested by central bank intervening and coming up with a rate ban, so that that has been addressed to a certain extent now. We also saw the restrictions on import basically affecting, of course, the import customers, but there were movement in towards the informal market, leading to some other dollars that should come through the banking system not being routed through the banking system. And also we saw the power crisis, the fuel crisis coming up in the first quarter, putting a lot of pressure on day-to-day life of all of us. And then the political environment was highly volatile, leading to social unrest. And we saw the sovereign rating downgrade, steep downgrade in first quarter. And now, of course, with the subsequently the government announced our inability to make the sovereign commitments, which resulted in we now being rated restrictive default category. But all that were basically happening. We saw that happening in the first quarter. And the inflationary pressure was continuing. As at March, the headline inflation was around 21.5. But we all know that the current official inflation as of April has gone up to 33. And I'm sure it's much more higher than what is being seen there. So that's the environment that we had to basically operate, very challenging environment. And banking industry who is in the forefront in the economic activities have to basically bear all that challenges. And managing that is the major challenge that we all are now working on. So the graph shows that how the rates have basically increased. The tightening situation from year ago, SDF rate of 5%. Now it has gone up to 13.5 and SLF of 14.5. But more importantly, actually, the what is reflected in the market through the treasury bills and bonds, which are now going around 23%, despite the policy rates are at 14.5, also shows the market liquidity constraints that we have, where all the banks are quite tight with that liquidity situation. So that's a little bit of background on the operating environment that we faced during the first quarter. And during the first quarter, NDP saw about 9% growth in the total asset base to 765 billion. And of that, loans had about 10% growth to 580 billion. Of course, partly due to the depreciation of the rupee, leading to the loans denominated in foreign currency, many dollars, are highlighted high. However, there was a slight growth in the book as well, but all in all, about 10% growth. And deposits, we saw 9% growth. In terms of profitability, the total operating income, we had 22% year-on-year growth. So at the top line level, NDP had been delivering and continue to deliver based on our run rate. So that is a very good achievement under trying circumstances. However, due to significantly high impairments, both from the loan book and also on our investment book, we were compelled to have substantial impairment, which I will describe later on. So our overall post-tax profitability had a 74% reduction, leading to 605 million. In terms of other KPIs, I think those KPIs have improved. Net interest margin has continued to improve to 3.43% from 3.25 in 2021. CASA ratio, again, despite the interest rates are going up, it has improved from 27% to 28%. And impaired loan, the stage 3 ratio, also to 4.40 from 4.5. In terms of group profitability, the group profit attributable to the shareholders was 539, again 77% down year-on-year compared to last quarter, first quarter 2021. And the ROE also coming down substantially because of these provision hit, and then as a result, the profitability from 12.4% to 6.8%. And the total group assets now stands at 771 billion, which is about 8% growth. Capital ratios still remain good. The Tier 1 capital ratio as at March at 8.679, and the total capital ratio of 13.36. Thanks to the retention of profits and also the capital raising activities that we did last year, where we raised more than 9.5 billion, getting no fund also as a key investor. And also towards the latter part of last year, we went and booked a substantial amount of debentures. Now, when you compare the rates going now, there is certainly a benefit where the rates are booked at a very good rate at the latter part of last year. So this is basically the overall snapshot of the performance, and I'll move on to explaining the financial performance. So Q1-2022, we had gross income level 22% growth from 15.7 billion last year first quarter versus 19.16. So that's 3.4 billion in quantum or 22% in growth. So that's actually confirming the strategies that were in place, ensuring that our loan book, the margins are contributing, and also the fee-based income and all. Of that, the interest income, 21% growth, 2.7 billion growth in interest income year on year. Whilst the interest expense, the quantum growth is only 1.6, but because of the interest rate increase overall and also the balance sheet growth, it's a 22% increase. So all in all, the net interest income, we saw a 1 billion growth or 21% growth to cross 6.2 billion in the first quarter. In terms of fee-based income, this is one of the areas that we have been working through our V25 strategy, concentrating on more transactional business, that fee-based revenue, the trade income. And that's shown results, as you can see, from 1.3 billion to 1.7, 30% growth. And also the non-fund based income growing up by 20%. So all in all, the operating income, we had 22% growth from 8.1 billion in first quarter 2021 versus almost 10 billion, 9.996. So about 1.8 billion growth in the first quarter. So it's all in all 22%. Top line, the things which are manageable, where all the strategic imperatives have been worked and the results that are shown there. However, now this is where the major issue has come in terms of the profitability impact, the impairment charges. We have basically taken 6.3 billion impairment charge for the quarter, compared to 2.1 billion in first quarter 21. So that's substantial, about 4 billion increase. One key reason is, of course, the escalation of stress levels. Post-COVID, the stress, the customers coming out from moratorium, and significant deterioration in the market conditions, the interest rates going up. All that basically have taken us, based on our models for the impairments, mainly the collective impairment models, etc., have basically taken higher impairment there. Plus, also the individually significant, the individual impairments, that also we have seen certain stress in some customers, so that we have taken adequate impairments there. And also the portion of our government foreign currency denominated government securities, and also the SLDBs, we have taken quite a sizable impairment. This is also impacted by the currency devaluation. So the value of that in rupee terms have gone up substantially, resulting a combined impairment of 6.3 billion. So the KPIs on the asset quality, impaired loans, the stage 3 ratio, it has actually improved from what it was last year to 4.4, whereas the impairment, stage 3 to stage 3 impairment as a percentage of stage 3 loans also have improved from 32 to 34. So that also shows that we have been building on the impairments as a very conservative bank, and ensuring that while the impaired loan ratio has improved, the impairment cover, we have ensured that that also has improved. With regard to the operating expenses, now this is, again, we have done quite a good job, remarkable, I must say, in containing the growth in operating expenses to 6%. When you see the inflation, official inflation, even as at March, 21%, Despite that, year on year, the increase is only 6% to 2.6 billion for the quarter. That again, the personal expenses almost on par with what was paid last year. And then the increase is mainly on the expenses side, other expense side, with that 23% increase, which is slightly in line with the inflation rate. So overall, still only 6% growth in operating expenses, thanks to mainly the cost management strategies. Also, the benefit that we have derived from the mass automation and improvements on the internal processes and digitalization of customer journeys, customer solutions, moving on to more digital channels. Those have basically contributed, despite the balance sheet growing substantially. This is, we are comparing a year ago quarter, 2021, first quarter versus this quarter. Despite the balance sheet growing up, we have managed to serve our clients and provide that service at a very high level, while managing the costs thanks to our digital investments. However, overall, with that, as I mentioned earlier, the profit after deducting all the impairments has actually come down substantially by about 72% for the quarter, from 3.4 billion in the previous year, first quarter, to 962 million. This is before tax. With after-tax profit has come down to 605, and profit attributable to shareholders, deducting all the subsidiary companies' contribution, has come down to 539 billion. It's all in all about 77% reduction in this quarter. Balance sheet, of course, as I mentioned, partly due to the rupee steep depreciation, but also first quarter we saw our assets also growing in terms of quantum. So balance sheet, total assets grew by 9% to 765 billion. Investments remain same, and then the loan book also had a 10% growth, and deposits had 9% growth. So total gross loans to gross total deposits still stand below 100%, close to about 95%, which shows that our lending is being supported by our own deposits, confirming the level of liquidity to support the loan book. And in terms of equity, overall equity was around 55 billion. Total shareholder equity, as I mentioned, tier one, we raised 9.5 billion in last year, and also 8 billion in debentures that have helped to ensure that the equity level remains strong. These are the investor ratios for info. Of course, the share price with all the market sentiments as at March end was 55 rupees compared to 68 rupees last year's March. Earnings per share has come down mainly because of the drop in profitability. ROE Sorry for that technical glitch. So in terms of capital and the liquidity position, the common tier 1 capital at group level stands at 9.19%. At bank level, almost 8.7%. Tier 1, and the tier 2 level 13.36, compared to minimum of 12%. Liquidity coverage ratio is much above the minimum requirements at 206%, and the net stable funding ratio also 118% compared to 100%. Now there again, the capital ratios, I must say that the central bank recently came up with certain leeway, offering certain leeway, because with the substantial increase in balance sheets due to the rupee depreciation, all banks would have face this constraint in terms of capital, because the capital is based in rupee, whereas the part of the balance sheet is in dollars, leading to a substantial increase in the asset base, leading to a lower capital ratio. So therefore, coupled with the potential impairment due to the steep increase in interest rates, the valuation of your government holdings, so all that have been taken consideration, and then central bank has come up with the release of capital conservation buffer up to 250 basis point. The direction was issued early last week. So anyway, we are not reached that level to make use of the capital conservation buffer. However, as we move forward, sometimes we may have to use that, but that's all the entire industry is also expected to make use of it. But that is one cushion available. Capital conservation buffers are usually built up in good times when the industry is doing well. You put aside certain reserves for that and build it up. And when a challenging situation comes, make use of them. So that's the whole idea of capital conservation buffer. So good to see the regulator releasing that and allowing the banks to make use of in case of a need incoming in future. Into screen. Right. Okay. So the way forward, that's basically covers the prepared presentation. Talking about the way forward, I think compared to the first quarter, the situation has further deteriorated, I would say, with one is the rate increase that has resulted in a severe liquidity challenge in the banking system, plus the foreign currency side. There's a substantial liquidity stress that is there in the market that has been coming for the last 2 to 3 months. Unfortunately, some of the foreign currency commitments by 2 state banks have been defaulted to several other banks as well, because state banks have been funding the country's essential imports in the earlier quarters. But I think when the country went dry off the reserves, they have been unable to make their commitments good, resulting in quite a level of stress in the foreign currency liquidity in the market that has affected almost all banks. So that is one challenge that day to day we have to manage. I think in managing that, I must say that NDB has been doing it very well, ensuring that our foreign currency liquidity situation is supported. And also we need to prioritize a couple of things in terms of even the new volumes that we take, new import volumes, of course, limiting it to the essential imports, given the country's need at this time. And so unfortunately, we are unable to do any other non-essential imports. And that is something that has been agreed with the regulator as well to support their real requirement. There had been certain mandatory selling to the central bank to ensure that countries' essentials are kept going. So the all banks expected to contribute a certain level percentage of our export revenue to the central bank. These are all, I think, market information. So going forward, a couple of things that we'll be working on is, one key thing is preserving the asset quality. It's very important in a economic downturn that we are proactively working on our credit portfolio, because that's where initially the customer would feel the pinch. Even the retail banking portfolio where customers have difficulties, so that more proactive monitoring, helping the clients, that is very actively happening. We can't support all the requests, but however, giving all due consideration for the stress level that the customers are in and trying to support them while preserving the asset quality of the bank. So that is one of the key priorities at the moment. Then the liquidity challenges, when the market rupee liquidity is also short by a substantial figure, managing that, ensuring that bank is always liquid, and that we have been very successful in doing that. Though there are stress in the market, the NDB has been doing very well to ensure that we remain strong in terms of our rupee liquidity, and also to foreign currency. Again, we have been managing it with certain challenges, but still I must say that compared to the industry, we have been managing it well. And also enhancing the deposit base. Basically, it's all across the bank. It should not be hot money, large deposits where you pay a rate and get them. You need to have more granular deposits as well. So thanks to all efforts of the retail banking and our sales team, we have been seeing quite a good growth there, and also supporting our clients to maintain resilience in these challenging times, whilst also trying to give the best return to the shareholders, but certainly not be able to deliver what we have been delivering in the past. We have been delivering one of the highest ROE in the past. But this year, naturally, I'm sure the shareholders are also aware of the challenges and trying to best give the best while preserving all our resources, applying all our experiences to manage this crisis. And then hopefully when the economic revival happens, we'll be one of the first to make use of that, because I think our groundwork is very strong. Our base is strong. We have a strong team who is managing, very experienced and very well connected team managing this. So I think when the revival happens, we'll be one of the first to make use of that and then do well when we bounce back. And separately, we have to work on capital augmentation plan. Now that the regulator has given certain leeway on the capital ratios, however, when we make use of those ratios, make use of those capital conservation buffers, we need to have a capital augmentation plan for the next 3 years to ensure that we get back to the minimum previous levels of capital requirement. So those are things that we are working on as we move forward. So that basically ends the prepared presentation, and I leave it open to all the participants to raise your questions, and me along with the panelists representing the leadership team are here to take any question. And I urge you to raise your questions, and there's a team who would collate that and then share the question, so that then we can probably repeat the question and provide our answers. Okay. Okay, there's one question on, given the liquidity constraints, have you started forcibly cutting down on loan growth? Yeah. I can take off the screen. The video option you can take it out. Yeah, stop sharing, and also the video option. So we'll leave the audio option. Okay. Yeah. Okay. So the question is that given the liquidity constraint, whether we have started or foresee cutting down on the loan growth. I think it's partly due to liquidity, but I don't think liquidity is the main issue, but due to the potential capital constraint as well, I think one has to be careful whatever we book. So loan growth, yes, we have curtailed that. One should also remember that I think in this significant challenging economic concern environment, probably growing the loan growth is one of the least priorities at the moment because we had to secure our exposure rather than going blindly taking some of the potential bad accounts as well. So we have been careful in growing that book. The next question is Tier 1 capital ratio of 9.9% of NDB group, including the capital conservation buffer? Yes, it is including that. Is the total Tier 1 capital ratio. Okay, there's a question on how much impairments have been provided for foreign currency loans as a percentage up to now. I think probably Swendani, can you take that?
So with the country downgrade again in Q1, we have increased our impairment cover. I think we are adequately covered as of 31st March. We had an impairment cover of approximately 7% as of December, and we on a consistent basis, I think across all the banks, we took it up to in the range of around 10 to 12% in the first quarter.
So far, these are the questions that we have received, but looking forward to some questions. I'm sure investor community have much more than these questions given the current situation here. There we got some whole heap of questions. Okay. Yeah. So there's one question on what are the last reported NPL ratio, even though the banks are not showing the ratio on a quarterly basis. I think we have shared that, right?
Yeah. So now with the new regulation, banks are showing the stage 3 portfolio. That is what is disclosed. So the last reported NPL ratio, I think what is referred here is the previous regulation. So there is no requirement as such now.
Yeah, that's another on the given reliefs of capital adequacy ratio. What are the plans on NDB having a lower capital buffer? Would they go ahead and adapt those market absorption thing? I think there's no option but for us to market and absorb that loss in our capital. I'm not clear on that question. Can you hear?
Yeah. So we are actually evaluating. The direction was issued about 2 or 3 days back. Definitely, yes, we will, if there is a need to take the mark to market, there is a relief for staggering the mark-to-market losses, we will be evaluating it. So at this moment, I think it's too early to provide any plans on how we will obtain the release.
There is a question on any plans on raising equity in the near term. All the negative impacts like restructuring, surcharge impact, and impact on CI level. So certainly, I think that is why the regulator has come up with the capital release of capital conservation buffer up to 250 basis point. We also very well know that this is not the time for any bank to go and raise capital, and also at a time that the price to book value of the bank shares, not to mention other shares as well, at one of the lowest. Not the time to raise the equity, because that would also dilute the existing shareholders, and raising it won't bring the desired result. So we have to defer the capital raising activities. So first, actually during this year, couple of three things, the priorities would be ensuring that how much would be the impact on SLDBS and ISBs each bank is holding on, and look at what would be the level of impairment and assess that, then the impact of the depreciation, and what would be the impact of the balance sheet, and take stock of that, and then later on towards once the IMF program is clear and we know the direction about I think along with the IMF program, I'm sure there'll be policy corrections, certain policy stands that would be taken, hopefully not to be changed, but that would remain for several years, so that we know there is a proper plan for the country's revival. When that situation improves, I'm sure that is the time for any bank to reach the equity market to tap new funds. So this is not the for any bank to make use of equity raising plans. There's a question on how other comprehensive income is treated currently, and what is the relaxation by the recent direction. So, Suendri.
So currently, any mark-to-market losses are considered as a deduction for Tier 1 capital purposes. What the direction has offered the relief is where mark-to-market losses which arose with the sharp increase in the rate by 700 bips. So such impact to be deferred over a period of 2 years. Of course, there are certain conditions given where dividends cannot be distributed and as such. So banks will have to evaluate and get the relief.
Okay. There is a question on how much of the loan book is towards SOEs. I think that's not a significant amount. I would say less than 5%. Yeah, much less than 5%. Very small. There is a question on what is the level of haircuts assumed for ISPs and SLDBs. BOC's expected loss rate on Forex, sovereign instruments and Forex loans and advances is 12%. Is this similar to that of NDB? And Suendri, you can answer.
On the expected loss rate, yes, NDB and most of the other banks are also in line with 12% cover as of 31st March. In terms of the level of haircuts, we have not assumed anything or accounted for a haircut in our accounts for Q1, but we have made these provisions based on the PDs and the AGDs, and that's how impairment cover of 12% has been considered. That again, the industry took a review from the external auditors as well.
There's a question on what is the Tier 1 capital after adjusting to exchange of 365. I think the exchange is at 359 now. But even at that level, still we are above the minimum capital requirement of 8%. So there is no need for us to get into the capital conservation buffer, even if we apply that as of now. There's a question on how does the bank perceive NPLs in the next couple of quarters. Okay, I would say that yes, that is a concern for all banks because one is the productivity of the country got affected with the power cuts, right? And then the non-availability of the foreign currency to continue. I mean, it's basically would come from all sectors, I would say. Even retail exposure, people would have lower spending capacity with inflation going up to around 35-40%. What is available for spending, what is available for servicing debt would get challenged. So is the corporates because of the productivity challenges they have. Whoever who's in the trading activity would also get impacted because whoever who's doing import-driven business naturally with the 100% cash margin, which are all for right reason that have been introduced. But if you're looking at corporates or the customer level, certainly that would have severe challenges, severe stress. So NPLs is an area that all banks, all finance companies have to be very watchful. That's why I did mention earlier, one of our top priority in our case is to ensure that these customers are proactively managed, look into their requirements, understand their ability to bounce back and provide them solutions now rather than wait for a few more months and then when they are really, really distressed, when they have taken make use of all the available resources, including other banks. We don't want to be the last. So this is a game that I think we have been doing quite well over the years. So proactively managing these accounts. But naturally, there will be a stress that would get reflected in the industry very soon. Okay, have there been any inquiry from potential overseas investors looking to inject new capital into the bank? I do realize you may be constrained as to how much you can say on this topic. So thank you for providing the answer also with the question. But yes, there are, I mean, one good thing is our key shareholders have shown their commitment in the event that NDB is required to raise capital, they would support. And there are recent central bank discussions also. I hope that would also materialize maybe in terms of the minimum shareholding requirements. There's some relaxation. There are some talks, but it's yet to come out. So certainly, given the positive track record that NDB has been doing, I think we have been very good at raising dollar funds even in the past, DFC loan, IFC, I mean, all that. So all that shows that there is a good story with NDB and having driven the digital capabilities, all that, the cost income ratios, all that, very good. There's certainly a case for investment in NDB. However, what restricts for the foreign investors is the current country rating and also the political stability. And I think that is why it is needed that we have to wait till probably the first quarter next year to see the situation improving. And when the country move forward with the IMF correction and required policies are in place, when you see that progress, when maybe the first stage or the second stage of the IMF funds are released, that is the time for us to approach these overseas investors. But they are all closely watching and have given us assurances that when that right time comes, certainly they will be one of the first to come and support us and invest in the bank. What is the forex exposure, state banks? How much is due? That's probably a bit of a, probably Niran, you can take that call. I mean, we don't want to disclose the numbers, but I think all banks have some exposure to state banks, and that is something that all the banks are having. There's a question on what is the expected loan growth for 2022. Again, as I mentioned earlier, we don't want to increase our loan growth for 2022 going forward. So it would be a very, very minimal loan growth. If we had to grow, it would be more risk-efficient assets that we'll be looking at rather than growing, and also based on the need and what sort of contribution that the corporate can bring into the bank. All that would be considered, so it would be a very minimal loan growth that we are expecting for 2022. There's a question on what was the exchange rate used for recognizing impairment of 12% on foreign currency loans.
It was in the range of around 295. That's as of 31st March.
So that was a rate at 31st March. Are ISPs and SLBs treated similar or different when it comes to provisioning? I think they were treated differently.
Yeah. This both. If you take ISBs, it was treated differently because the impairment cover was higher there, and SLDBs, we treated it differently. So that was in line. I mean, across the industry, there was consistency in that.
So these are the questions. Probably, Niran, probably you can update a little bit on the market liquidity, a general update that would be useful. I'll ask Niran, who's our head of treasury, to give an update about the market liquidity situation and all. A general, probably that would be useful for the investors.
Yeah. More than the liquidity side, I think I'll just mention a little bit on the exchange rate. I think there is some stability coming in after certain measures taken by the central bank after the new governor came on board. I think it was very much welcomed by all the banks, and I think the market participants are all committed to somehow see how we can stabilize the exchange rate at the current level, or even try to bring it down a little bit at least. So because otherwise, with the escalation of costs, it will be very difficult for the country to move forward. So these certain restrictions came on these open account transactions for the importers is very much welcome, which were actually in our agenda even during the last week. In certain forums, certain discussions which were brought in. So it's nice to see that they are now being now has come into operation. So that definitely will reflect some positives and also probably steps taken to restrict the grey and the black market. That will enable some of the remittances to come through the banking sector. So it's very much welcome. So there are a lot of positives happening, and the market participants are also working together so that you can bring in the most wanted stability and also to get the exchange rate under control. And from the other side, from the liquidity side also, the moment the IMF hopefully, now yesterday also there was a comment on that they are getting ready now to give a firm commitment. And that comes into and also the political stability is also very, very important at the current juncture. So that will help the market liquidity levels as well, even from the foreign currency side, because we have seen certain investors checking on certain because you have seen the interest rates at very high levels at over 20 on the bills and bonds. And they have seen the exchange rate of stabilizing around the 360, 375 area. So they feel that may be an opportunity for them to come in, but it will be too soon to say. But if anything, any positives come from the IMF will definitely be triggered. So that will be the trigger point for the country. So somehow, if the political stability comes in and we move forward with the recommendations of the IMF, then I think that would be a trigger point for some of these foreign investors to come in. Of course, initially short term, but probably we can look at some positives on the medium term. And I think interest rates also from the rupee side also should stabilize, because currently
there is a question on what is the expectation on rates.
Yes,
because the rates could edge up further up.
Yeah, because we saw that there was signs of moving further up, but in the week before the auction, 1 week before what they actually rejected the auction, they took a very small amount. But in the last auction, we saw it was very much oversubscribed, and the whole thing was taken at a much lower level of about 0.5% to 75 basis points lower, and even secondary market is trading even lower than that. So that is a good. That is good actually to see that the rates are also curving a little bit lower. But we may not see an immediate adjustment, but at least if we can stabilize or stop it from moving further up, it will be a good movement. So we can clearly judge it from the Monday. We can get a clear direction again from the Monday's auction also, the 3-year and a 5-year bond auction coming up on Monday. And we have not seen exorbitant rates in the secondary market as well. So overall, we feel that the interest rates also should stabilize around the current level. And also, as long as we curtail the government expenses or the SOE's expenses, I think we should be able to manage until until the IMF works out.
These are the questions that we have. Do you have anything? Other questions?
No.
So I think given that these are the questions that we have, we'll close our investor webinar. Thank you very much for your active participation and also asking some valid questions. I think the one assurance that we can give is that NDB is quite actively involved in managing these challenges, and we have a good team and also a good board also to support. And I think we have been on top of managing the liquidity challenges and other challenges, and we should be able to manage. We are confident that we can manage the current challenges that we have received from all fronts. I think it's basically supporting our clients and ensuring that they are taken care of, and providing with the regulator there is certain arrangements that even the Sri Lanka Bank Association is working together to support. So a lot of things are needed because we, as an active participant in the economic revival, we have a big role to play. So I think going forward, NDB would be involved in ensuring that our required commitment and contribution for the economic revival is there. So thank you very much for all the participants being part of that and being with us today. Thank you. And with that, we will conclude our investor webinar.